Hello and welcome to the Fat Profits special webinar today, titled Banking Wobbles 2023. My name is Roger Malik, the host of today's webinar and also Head of Client Services in Fat Profits Sydney office. Joining me today is our Senior Account Manager, Chris Balafas. Chris, welcome to today's special webinar. How are you today?
Thanks, Roger. Yeah, good to be here. Nice to be with you, and also welcome to all of our attendees. Looking forward to today's webinar.
Well, thank you for your company wherever you are in the world, and depending on the time of the day. I hope you grab your pens and papers, cups of coffee or beers or whatever beverage you like, because today's session is going to be full of information. We've been preparing for this for some time with all the market volatility that we are now seeing, banking wobbles, a few banks in the US going under, high rates, and there's a lot of moving parts. So we're going to try and make some sense of it today. Hopefully by the end of today's webinar, you walk away with some clarity on the markets and some insights on how Fat Profits is positioning themselves, because we manage real money in the markets as well. So we're here to provide you some free information today. And if you find it useful, let us know and send us some feedback. That would be appreciated. Now, before we get into today's webinar, just a quick look at our panel. Some of these names or faces you may have seen, you may have come across. So our CEO, Angus Geddes, a founder of the company, and also our fund manager, managing over $200 million in the Australian market. And then you see myself, Roger, the Head of Client Services, followed by our resource and mining analyst, David Lennox. He's very popular, quite quirky, been in the markets for over 30, 40 years, lots and lots of experience, specializes in mining, of course, also a geologist. So we've got a wealth of experience here. Then we have Gary Burton, who is a technical analyst, but also an equity analyst. He's got his certification in technical analysis, very, very strong on the charts and indicators. He's run a few workshops for our members, one of the popular guys in the market. Andrew Blackmore, our equity analyst, has been with the company for many, many years, over a decade, and specializes in the Australian and global markets. And of course, we've got Chris here joining us today. Chris, you've been with the business for how long?
Yeah, 12 years this year, Roger. And I can see there's a few ex-members in the webinar today, so I look after quite a lot of our existing members.
Very good. Well, 12 years is a long time. You're nearly part of the furniture, Chris. So look, that's to give you a bit of a heads up. But yeah, we have a lot of experienced people working for the business. Now, as you may have seen, some of our logos. We always say, don't follow the herd. We're a bit contrarian in nature, and we like to follow our instincts, our research, and sometimes we go against the crowd. Now, before we start, quick housekeeping. All our presentations, including today, are general in nature. We don't take your personal situation into account. If you're looking for personal advice, please see your financial planner or advisor. And also, past performance is not a reliable indicator of future performance. Now, today's webinar, we'd like to make it interactive. So if you have any questions, you'd like some clarity, you can type those questions where you see the orange arrow, and we will do our absolute best to answer as many questions as we can. We try to keep the webinar to around 40 to 45 minutes if we can, and we'll do our best to answer these questions. Now, keeping in mind that we do have a Q&A at the end of the webinar, so if you do have questions towards the end, we'll certainly take some towards the end of the webinar. All right, let's get into the markets. First thing first, let's look at the big news. As the title of today's webinar, Banking Wobbles, we know what's happened recently is the Silicon Valley Bank, SVB, became the biggest bank since 2008 to be going under. It's now been closed, it's taken over by the authorities, and the last big bank which was shut down was Washington Mutual. As you can see on the charts in front of you, in 2007, right at the peak of the global financial crisis. Post that, look, we've seen plenty of other banks go under. This does happen. We don't hear about it quite often, but this is the second largest bank since then, worth over $200 billion. It was Washington Mutual was over $300 billion. Now, how do we compare that to, let's say, our biggest bank in Australia, which is CBA? That happens to be $160 billion worth, and Silicon Valley Bank is over $200 billion. Now, just to put that in perspective, of course, CBA, I mean, just it's hard to imagine though, but hypothetically speaking, if CBA was to go bust, I mean, you can only imagine the ripple effect that'll have throughout the economy, because it's our largest bank and we're a small economy. However, we're not suggesting that's going to happen, but just to put that in perspective, Silicon Valley Bank is the 16th biggest bank in the US, and yes, certainly has a huge impact on the regional banks. They were lending out to tech startup companies, but what's been happening behind the scenes, which we only found out only days ago, was a lot of deposits were leaving the bank. As you can see on the charts here on the extreme right-hand side, the deposits were coming out of the bank because they invested into treasury bonds, long-dated bonds, I might add. And as the bonds have been selling off in the last 12 months, it's mainly thanks to these rate hikes that Jerome Powell led Federal Reserve have been raising for the last 12 months. And because of these high rate hikes, the bond market has fallen off the cliff, and some of these regional banks who were highly exposed to bonds, they faced unrealized losses to the tune of tens of billions of dollars. And when people started getting sniff of it, they decided to run for the exit door. And when that happened, of course, the banks collapsed. Now, before we look at banks a bit more detail in a minute, we know what's happened, and what's caused this is the steepest rate rise in history in the last 50 years. Now, maybe I'll get a quick comment from you, Chris. A year ago, we were sitting at nearly 0% interest rates, and now we're closer to 5%. And it's had a huge impact on many economies around the world, housing sector, property market, regional banks now. What do you think? I mean, we're getting closer to the end, but it has a huge impact. What are your thoughts on the biggest rate hike in history?
Yeah, and that's put a lot of pressure on a lot of sectors, even a lot of people. But it just, listeners, attendees, it just shows the impact of the collapse of the bank that Roger was saying with Silicon Valley, the significance around what's happening with the banking sector. And now Mr. Powell, which we will touch on, is just in where the interest rates are at the moment. Do they continue raising it, as we can see here, or do they put a pause on it? So it's very interesting to see what's going to happen because of this banking crisis.
Yeah, absolutely. And look, they're not the only one. We've had 3 banks in the US have gone under so far, and we suspect there might be a few more, perhaps. Hopefully not, but there could be some more damage in the near term. Let's look at the financial index and see how it's been tracking over the years. You can clearly see on the charts on the left-hand side when the GFC 2008 housing crash in US happened, the financials really buckled and they literally lost nearly 80% of their value. But post that, look, we've seen a recovery. There's always light at the end of the tunnel. There was a reset of the financial system, and we've seen a pretty significant recovery in the financial sector. We saw in 2020, of course, another big drop, but that was a quick recovery. In fact, a big boom following the COVID breakdown. But now you can see on the right-hand side another decent drop in the recent days. But that's all reasonable if you look at the overall financial sector still. However, the regional banks, not so much. And this is a clear show that the regional banks' health is not the same as the overall banking sector. Now, do we see more drops in the coming months? Unfortunately, yes, because they're not as regulated as the big banks. There's more than 4,000 banks in the US, I might add, compared to a handful in Australia. And out of them, it's hard to regulate all the regional banks, and a lot of them have not got risk management in place, just like Silicon Valley Bank, and they are now getting pummeled by investors, depositors, and now running away from the banks and taking the money back into big banks, and money is really flowing out the door. So that could cause a spiral effect. And now, Chris, this chart here is quite interesting because it only has happened twice in the last 20 years that we've had 2 years in a row where no bank has failed. But the last time this happened was in 2005, 2006, when no banks failed, but that was followed by 2007, and we know what happened. But recently we've seen the same thing in 21 and 22, and now here we are in 23.
Yeah, it's quite a good graph, this one for our attendees. So as Roger said, as we can see here, 2 years of nothing, and then we had the spike in 2008, Roger, and then history will show, well, we've gone through in 2021, 2022, and then we've had the next biggest bank collapse. So just a good gauge for our listeners. And members do appreciate this, just the macro behind, what we're always looking forward. So it's just a good gauge for you, webinar attendees, as to where we're looking moving forward.
Absolutely. Thanks, Chris. And look, there's always reasons behind why this happens. And of course, the big reason, which we're going to look at in a moment, is, of course, the huge rate hikes that usually causes something to break. And we're seeing the first crack in the economy through the regional banks. And look, who knows what else is around the corner? So there has to be a plan in place for every investor to navigate these choppy times. And we are going to talk about the plan. So 2 things in focus for the rest of 2023. First is earnings. It's all about company earnings. And we've seen Q4 earnings for US market, which was a bit lower than expected. However, the Q1 earnings, which starts mid-April, will be very keenly watched, and we suspect that earnings will start to come under pressure, and the company's profits and losses will be keenly watched. The second thing is, which is now being priced in by markets slowly but surely, is a recession in the US. That is on the cards. It is questioned by the bulls. They're saying there's no recession coming. The bears are certainly sitting in the camp calling for a recession in the coming months, and we're going to give you our opinion in a moment. But here's probably the worst job in the world at the moment that nobody would want, Chris. Jerome Powell is really stuck between a rock and a hard place, isn't he? Because he's got to now navigate the 2 big jobs on his hand. On one side, he's got sticky inflation, which is not going away quickly, and he's trying to raise rates to beat it down. But on the other hand, now he's got a banking crisis, which is imminent, and he's now trying to hold off further problems. But which one does he solve first? If he stops raising rates, then inflation could start spiraling back up. But then if he continues the rate hikes, then we could see more and more banks to falter, and that could cause a sentiment problem in the market. So this is a seesaw that now he has to navigate over the coming months. Not an easy job, not a job that anyone would want, but that also leads us into the labor market, because, Chris, the labor market has proven to be very strong, in fact, way stronger than what the central banks want. Because maybe you can run us through the last couple of job numbers, because 500,000 jobs in January, 300,000 jobs in February, a lot more than forecasted. That really shows the resilience of the labor market so far.
Yeah, so this is another good chart. So as we can see, it did definitely, coming into October last year, was falling. And then we've got this massive January, and even February was quite good too, Roger. So it is good to see, even though America, you could say, looks like a mess, it's still great to see that the non-farm payrolls, jobs are still increasing in the US. So, we as even Fat Profits, we really look closely as to these figures that come out each time.
Yeah, look, in a normal economy, this will be cheered by everyone.
Yeah,
everyone
exactly.
will be very happy, right? Saying everyone's got jobs and this is a good, healthy economy. However, that's what the Federal Reserve don't want, because this is causing inflation. at least for the time being. They do want to break this down so they can get on top of inflation and declare a victory. Now, what's happening with unemployment, on the other hand, just up until January, we were sitting at 3.4%, which was a 50-year low. It's tickled up a little bit, 3.6%. Expectation is that now this will start to rise as interest rates take a bite out of the labor market. Now, let's have a look at a couple of charts which look very interesting. And this is part of the research that we do at Fat Profits. And you might find this one quite a valuable chart. I'll explain. So the green buildings, if you like, or the green lines you see, is the federal funds rate, and the orange line is the unemployment data. So if you first look at, this is a very long-term chart, by the way. So if you look at historical data, you see in 2000, Federal Reserve started cutting rates because the economy was actually in trouble. They started cutting rates, as you can see where the mouse is. And as that was happening, unemployment started rising because the economy had already hit trouble. A similar thing happened in 2006 and 7. They were raising rates, they paused for a while, and as they started cutting, unemployment started rising, leading to a recession. Unemployment, by the way, is a lagging factor. It's always the last thing to break in the economy. And we saw the similar thing happen before 2020. Rates were rising, unemployment was falling, but of course, COVID was a irregular thing. It just happened as a one-off, very quickly for 1 month. So unemployment shot up, rates were cut, kept low, and then unemployment came down. Recently now we've seen Fed funds rate gone up again, very dramatically, which is so far unemployment has gone the other way around, but we know that's a matter of time before the Federal Reserve pauses rates for a few months, and then unemployment really starts to tickle up, leading us into a recession. We do believe that is on the cards. And if you look at inflation, look, this is again a very long-term chart. For those of you who are old enough to remember the late 70s and early 80s, you might remember that inflation back then was running at 14%. I mean, that is unbelievable. And then it took years and years before it was brought down to the normal target. The red line that you see is the 2% target that all central banks vouch for. It took years before it was brought down because that was embedded in the system. We saw something similar happen in 2008. Leading up to that, it was rising up to about 6%. They broke the back of it, but the economy came down with that. As you can see, went into negative territory. Recently, we've seen inflation spike back up again to very high levels. It's starting to come down, but it's going to take time, and that's what it's about. So, Chris, maybe I'll take some feedback from you, because currently the core inflation in US is 5.5%, still high compared to where the Federal Reserve wanted to be 2%. What are your thoughts on the inflation data?
Yeah, it's an interesting one. These are two really interesting slides, because the one that we just showed was the CPI figures. So as Roger said, we went up to nearly as high as 9.1. And look, it is good to see it coming down. But the core inflation is actually a very interesting one that a lot of people usually don't look at, Roger. So the core inflation is basically inflation in the country, except for the food and energy sector. Now, we look at that quite closely, but I know, Roger, that also even the feds around the world, they really look closely just to see, yes, they obviously want to know what the CPI figures are, but they really look closely to what the core inflation is. And yes, it is still quite high at 5.5, but that also is a big indicator as to what they're going to be doing, whether they lower the interest rates, whether they continue to rise it. So the core inflation is actually very, very interesting a gauge to what they want to predict for another interest rate.
Excellent point, because that's the real measure for the Federal Reserve. And because this is proving harder to break down, they have to do a bit more and for longer. So that's the unfortunate truth. Now, what's also happening behind the scenes that's important for you to know is that the personal savings of consumers, which was really built up to the highest level in years during COVID days, As you can see on the charts here from 2020 onwards, this was well over, in trillions of dollars really. But now it's finally running dry. It has now come back into negative territory, and savings have come down to very low levels. People are now using credit cards. Debt levels are now starting to rise, and there is pressure. So this is the impact of huge rate hikes. Now, leading into one of the key indicators of a looming recession is the bond yields inversion. Now, just to explain what that means, it's the difference between the 10-year bonds versus the 2-year bond yields. So when the short-term bonds, which is the 2-year, is higher than the 10-year bond yields, that's when the bond yields are called, they're inverted, which means they go into negative territory. And every time that's happened, without fail, we have seen a recession. And here's a few charts to show you. And the recession is these gray bars where the mouse is right now. That's when recessions have happened. And you can see before that, the bond yields inverted and they went below zero. And a few months after that, we saw a recession. And we saw the same thing happen in 2000, dot-com bubble, bond yields inverted, followed by recession. 2008, bond yields inverted, followed by recession. 2020 became very close, but it was a very quick recession, and then back to normal. Now, this time around, the bond yields are so deeply inverted, it's not funny, that the last time this happened was in 1980. So this is a clear case of, if things go as history has shown, we are looking at a recession in the US. And will that happen in Australia? We'll talk about that as well a bit later today. Now, finally, before we move on to some other key topics in Australia, let's finish off US by looking at the chart. So maybe, Chris, you can shed some light on the S&P 500, please.
Yeah, and I've got a question as well from a Stephen, Roger. So I'll explain what's happening here, and then maybe you can answer Stephen's question. Sure. But there's a lot of indicators, attendees, as to why we feel the markets are going to be correcting, and there is a recession on the loom. But I mean, you've got strong US dollar, interest rates, inflation, and then we've added this new elephant in the room, Roger, the banking crisis. So this is where Gary Burton, the equity and technical analyst, really came into his own, where we feel that there will be a correction around the 3,200 levels, as we can see indicated here, before we feel the markets will have a bounce back by year end. But it's good that we actually have this question during this period of our webinar, Roger. So Stephen just asked you, I'm in cash, you're talking about a correction, so let's just say a correction, recession that we're talking about. What do you think, or sorry, when do you think this will happen? So, Roger, your crystal ball for Stephen?
Yes, let me find the crystal ball from under my desk. But look, and all jokes aside, Stephen, thank you for your question. And look, you're not the only one at the moment. We are speaking to a lot of investors who work with fat profits, who are sitting on a pile of cash. There is plenty of cash on the sidelines. People are waiting for opportunities, and why not? Look, if you're an astute investor, you know that buying on the dips, buying in these bear markets can bear a lot of fruit. So I guess to answer your question, when is it going to be a good time? Look, in our view, if you look at the US markets, we've been hovering around 3,800 to 4,200 points in the last few months. We do think the bear market will continue over the coming months, and anything around this 3,200 to 3,400 points, where you see the two support lines, we think somewhere around that would be a good time to put the cash in the market. Will that be the absolute bottom? Well, nobody knows. No one's got a crystal ball, but we do think, looking back at history, if you can pick up some quality companies, quality sectors, and put that cash in around those levels, use common sense, use dollar cost averaging, and buy a few times during these dips. And if you're a medium to long-term investor, we think on the other side of this bear market, when the bull market does take shape, a lot of investors will benefit from this, and we are one of them. So hopefully that gives you some clarity. And one final thing I will add is fat profits. We are sitting on about 25 to 30% cash in our managed accounts, managed funds. and our CEO, Angus, he is watching the market like a hawk every single day. We're looking at a lot of these key indicators, and when the timing is right, we will start dollar cost averaging, and we will start buying companies which are quality companies, and we will certainly look to take advantage of these opportunities ahead. All right, let's move on to Australia now. So look, recently, as most of you know, we've had our reporting season, February, March, when companies report their earnings. Now, how did we fare? Let's have a quick look at the Australian reporting season. Now, while if you look at the top level numbers, 30% companies reported a fall in profits, and they were down to $40 billion. 5% reported a growth in dividends. I think the key thing to look at here is while 11% showed an improvement in sales, 15% showed a rise in expenses. And that's really what it comes down to. Expenses have gone up because of rising rates. Hard to find labor, as well as rising wages. So expenses certainly have gone up. Now, if you look at the next slide here, this is important to note that only 41% of companies actually lifted their profits. And this hasn't happened in a very long time. So this is something to keep a very close eye on. And just to show you in a graphical format, you'll see on the extreme right-hand side, only 41% of companies reporting a lift in profits. And you look at the last 3 years, there was huge profits due to COVID, but even before COVID, this was not as bad. And part of the reason we believe is that expenses have gone up. And Chris, maybe I'll take a couple of key points from you, but this chart also shows that expenses in the blue have certainly shot up the most in the last 5 years versus the sales revenues for companies.
Yeah, and just shows the stress as well that they're going through, Roger. So you can see the interims of 18, 19, 20. So again, just a good gauge of the ASX 200, just how the expenses are actually outpacing the revenue, and just these companies just trying to find a balance so that they can obviously continue doing what they've forecasted.
Absolutely. So look, the companies are very similar to normal households. If your expenses go up in your day-to-day living, what do? You cut down the expenses, you reduce spending, and you wait for the storm to pass before normal times resume again. So companies are starting to do that now, and we expect that's where unemployment will go higher, because they will start cutting expenses which they don't need, and they'll shore up their balance sheets. And that's what is expected. So one has to be really careful in terms of the companies you hold in your portfolio. So we do suggest, as a bit of a general guide, is to do a bit of housekeeping, do a bit of a health check of your current holdings, and see which companies are questionable, and maybe it's time to raise the cash levels and get rid of some of those companies. And let's have a look at the Australian cash rate. Now, Chris, there's a lot of talk that Mr. Lowe is now closer to the end. We're now at 3.6%. The expectation is that next month probably be the last rate hike, if at all. He has signaled he's getting closer to the end. What are your thoughts? Even if it raises by one more time or not, do we feel that we've done enough in Australia, and how does this shape up for the rest of the year?
Yeah, well, that's it. Have we done enough? So the governor here, Mr. Lowe, yeah, it's another stressful job, because we're at 3.6 at the moment, but we've got inflation around the 7.8 mark. So this is the Australian elephant in the room, so to speak, because we are feeling it. The companies are feeling it. And yeah, where are we going to go with the next interest rate, and are they going to maybe start easing it? And then it'll be interesting to see, Roger, where the markets will be after the potential next one. But a good question just come up, Roger. Maybe I could just ask you. It's
Sure.
from Mary. Now, she's just said to Chris and Roger, so maybe you, Roger, you can answer this one. You spoke about US correcting. Do fat profits think Australia will enter recession? Good question, Mary.
Actually, very good question. Look, if someone asked this question about 3 or 4 months ago, I think most economists would say no, Australia would be fine. We've got a very good economic backdrop. Our financial system is very strong. Unemployment is at record levels. Everything seems to be humming along. Our mining exports are at record levels. Everything seems to be in line to withhold any recession fears. However, fast forward to today, and a lot of economists are now starting to change their tone. And look, our view at Fat Profits is there is a significant damage done by raising rates quickly, which, you know, the Reserve Bank has been behind the curve. If they acted early enough, we wouldn't be in this position. So look, let's call a spade a spade. They put themselves and the rest of the economy in this position because they were too late to the party. And once they were late to the party, then they got drunk, and now they're falling over. And with that, everyone else is. So to answer your question in short, do we think Australia could go into recession? Yes, we do. Do we think that's a story for the second half of this year? Look, we think Australia still is in reasonable shape compared to the US. So we think if at all we go into recession, it's a story for early 2024. However, there are some cracks now starting to appear, and we will be watching this very closely. So one must be watchful, and you must position your portfolio accordingly. Now, let's move on to bear market phases. And this is something to keep an eye on as an investor. Typically, bear markets have three phases. The first two phases are not as steep. The third and the final phase is the one to watch out for. We believe we're now very close to entering the third and final phase of this long bear market, which started about 12 to 14 months ago. And we think it's still got a few more months before it's over. And when the final phase comes to an end, pretty much that's called capitulation, where people throw in the towel and they push the sell button, they panic, and there's a lot of fear in the market. At the moment, it's very early stage of the third phase. We think there's still a long way to go in the coming months ahead. And when that does happen, that's the time, as Warren Buffett says, be greedy when others are fearful, and be fearful when others are greedy. So we have to be a little bit greedy if you are in cash and wait for that time to come. However, as we always say, Chris, there's always light at the end of the tunnel. What do we mean by that?
Yeah, well, the next slide will show that. So we're just telling you today, attendees, you know, there is things on the horizon, but we're forward looking. The positive, this is such a great graph, Roger. So just to give our listeners an idea, so it says the average returns overall in the following 12 months are higher if you wait until 1 month after the trough than if you invest 1 month earlier. So the trough, basically the business cycle when a recession ends, and we're talking about the economy recovery right there. So it's good to have a crystal ball, but if you get it right, the bear market trough, which is where it ends, you've got a great chance of having an incredible 12 months, but it all comes down to timing.
Yeah, look, timing is important, but we do think time in the market is also important. So our suggestion is, look, this shows that 36% returns are typically had in the market in the immediate 12 months following the end of a bear market. Now, even if you're 1 month before or after, or 2 or 3 months before and after, you're still looking at 20-odd%. Pretty strong year. You can make significant money. So, you know, don't be fooled by trying to time the absolute bottom. But even if you can get in before or after, you'll be fine. So what do? Well, one of the things we suggest is, you know, raise good levels of cash. Cash is king in a crisis. And as we've said earlier in the webinar, and I'm just looking at the number of attendees, Chris, there's about 460 odd people watching the webinar right now. So it's quite a few people. I suppose the message to them, if they didn't join us earlier, is we are sitting at 25 to 30% cash in Fat Profits. The rest is invested. So we never suggest 100% cash, but that's a bit extreme. We are mostly invested, but we're keeping the powder dry for the opportunities in the months ahead. Chris, over to you. Could you tell the audience today a little bit about Fat Profits, who we are and what we do?
Yeah, it's great to hear there's that many people, and I'm pretty sure out of the 460, there's probably ex-members in there of Fat Profits. If you're new, then hopefully you're learning a little bit about what we provide today. But a lot of you would know who Angus is. So as you can see, I love that little point he makes there, Roger. So when he was a young lad, he turned $200 into $35,000 on the stock market. But he's still our CEO and owner of Fat Profits. So we opened it in 2000. We have a London office as well that we opened. I spent 5 out of my 12 years in the London office. We look at the UK markets and the European markets there, and there's a team there. Then we've introduced the wealth management division. Many of you would know that part of the business, and that's where we've raised a lot of the capital. He'd been a Kiwi, he had to open up a New Zealand office, so we've got a little team over there as well. So all the different offices, we cover all different markets, and that's been a real benefit to a lot of our members, whether they're looking at just Australia, the Asian markets, mining, the UK, America. We are covering all different sectors, but Angus is still the proud owner of Fat Profits.
Thank you, Chris, for your 12 years with the company. 5 years in London must have been a good time. But just to clarify, we're not stockbrokers. We are a stock market research firm. So we simply provide the research. Our members take advantage of the research, and then they manage their own portfolio. So you manage your own money. We don't touch it. We don't get involved. You simply use our daily and weekly guide, our buy, hold, and sell recommendations in different markets to benefit from. So that's what we do. And part of our team also is David Lennox. So Chris, you worked with David for years. Could you tell us a little bit about him, please?
Yeah, if you know Fat Profits, you probably know David Lennox. He's, I like to say, the face of Fat Profits. He's usually on most Ausbiz, CNBC, Bloomberg. He's always been interviewed. But yeah, he's incredible. David is, as Roger mentioned earlier, he's one of our geologists when it comes to the mining sector. And usually, yes, I've got a good relationship with him. We both like AFL, but if I ever have a question, especially from a member of ours, Roger, I'll usually go to David and get the answer. So he's always approachable. He's very knowledgeable when it comes to the markets. And as I said, a lot of people would know who he is.
Yeah, sure. He loves the AFL. He's a Richmond Tigers supporter, so believe it or not. All right, let's move on to a few sectors now. So we've done the macro analysis. Hopefully, if you're enjoying the webinar so far today, and we've given you some insights on how the markets are moving and what to look out for, please do comment and let us know. There's a few more good bits of information we're going to share with you now, and we're going to give you a couple of stocks as well in a moment. But first thing first, let's look at the 5 sectors to watch in 2023. These are the 5 sectors that Fat Profits is certainly keeping our eyes on, and we have investments in those. So firstly, energy, oil and gas in particular. We're currently holding the stocks in there. We're not buying stocks anymore. We do think it's got some weak days ahead. And as we see, us enter closer and closer to that recession in the US, we think the oil and gas industry and the prices in particular will cool down due to fears of recession as the demand slows. But once we get to that bottoming process, we think that will be a great time to turn the current hold recommendations into buy. And that's what we're going to be buying, a lot of quality companies listed on the ASX. So that's something to keep an eye on. Commodities, on the other hand, we are quite bullish on commodities in general. We think we are in the middle of a super cycle, and this will last another 3 to 5 years. A lot of our mining companies that we are recommending to our investor base are still buy recommendations, and we're buying them on the dips, dollar cost averaging. The next sector is property, and look, it's no secret that property has been under the pump with rising rates. I mean, you'll be living under a rock if you didn't know that, but I think the key thing is we have sold a lot of these property stocks a month ago, and we are just sitting back and watching, and that time will come when they will reach really good value, and that time will be certainly welcome as an investor. We will be watching and getting ready for that. The other 2 sectors to look for is financials. We are going to talk about the Australian banking sector in a moment and the financial technology companies. Quite a few of them are hold. and we're going to touch on that in a minute. And last is gold and precious metals. And this is something we are buying right now. We've been buying for the last few months on the dips, but gold, and more gold in volatile times. So this is what we suggest. Now, quickly, Chris, recently we reviewed all of Australian banking sector, and we moved our recommendation, which was previously a buy, to now a hold. This was a few weeks ago, before all this fiasco took place. Could you shed us some light on the Australian banking sector's health and our views that are currently for the banks?
Yeah, so it just shows that if something happens, our members are alerted as to what we feel you should be doing. So we've done very well with the banks, just like a lot of Australian investors do. They hold the banks, and especially when it comes to income, as we can see here. But just with what's happening recently, with a lot of our data, we'll look at what's coming out of America as well, Roger. So with interest rates and inflation are still the big issues. So we just thought, look, what we're telling our members to do is keep that cash. Don't sit there continuing to buy in the banks. So we love the word patience. It is very difficult to do in the stock market, but we're just telling our members, just please hold for now. Let's just ride the volatility, see what more data comes out. And then Roger, no doubt, when we feel comfortable, we will start alerting our members to dollar cost average and get back into some of these banks.
Absolutely. Great example there, Chris. So look, yes, that's our plan. We do think Australian banking sector is quite unique, and we don't think we're in trouble just because what's happening in the US regional banks, especially our big four banks, are quite safe. The AAA rated. Our big four banks are 4 out of top 10 banks in the world which are AAA rated. So we're quite good. And well regulated, so we're not worried about them. But yes, there will be a spillover, and they're feeling a little bit of pinch because that's just the market sentiment. But we may turn our recommendation into a buy in the coming months when we feel the timing is right. But if you're a member, you'll certainly find out when that is. But at the moment, we're watching the space. Next up, let's give you a couple of stocks today that you guys can add to your watch list. And these are names that you may or may not have looked at, because we're not here to give you buy the banks and buy BHP and Telstra. I mean, you can do that yourself. We're here to provide names that people may not have seen or heard of, or if you have, you probably never really looked into them. So here's the first of two recommendations we're going to give you today. Collins Foods. Now, some of you are quite familiar with KFC, the Colonel. I'm sure people have bought them on Friday nights when getting together with friends. But Collins Foods is the parent company, and they own not only KFC, but also Taco Bell. In the past, they used to have Sizzler restaurants in Australia. And look, quite a household name, of course, if you look at the brands. Now, if you look at the overall financial health, they are not only in Australia, they're also based out of Europe. They have a lot of exposure in Netherlands and other parts of Europe. But if you look at the last update, while the revenue went up, they actually faced some challenges in their overall costs, which also went up, and that put pressure on the profit margins. Now, this is the first report in over 10 years that I can remember where Collins Foods actually disappointed, and the investors let them know. Now, typically, Collins Foods always come up with very good earnings. As you can see here, right at the bottom, the earnings revenue has typically gone up over the years. However, the profit margins got squeezed due to supply chain issues and cost pressures, and that put a little bit of pressure, of course, on the bottom line. So what's happened, Chris, over to you, because this is a stock we have bought many, many years ago, early days, just over $1.30.
Yeah, and good example of just dollar cost averaging. It's actually a brilliant company. They pay a small dividend. Yes, the share price has dropped in the half yearly earnings, and that's also down to consumer discretion. Just spending is a bit under pressure. But just talking to the analysts, they still remain well positioned even with a very low debt ratio of only about 1.3. So as you can see, we bought them very early in 2016. We bought them again at $4, $11, $12. Then we've seen this, they jumped really high. And then they've just come down to a point. There's a support level of around $8. Gary Burden was saying, but we can see a lot of potential with this company. So we just thought we'd put it in the webinar today because a lot of our members also would like to know, what are we watching? And then we'll alert them when it's actually a good time to start putting money in.
Good on you, Chris. And look, this is another case of early bird catches the worm.
Yes.
Because you've got to get in early in these household names. I mean, anyone who's bought CBA at $5 at IPO, you remember that in the 90s, it's nearly $100 at the moment. You'd be very happy. Early bird catches the worm. So this is another classic case. You've got to get in early in these companies and have lots of patience. As Chris said, dollar cost average along the way. You don't have to put your house on it on the first day, but certainly keep an eye on the dips. Next stock is also a similar story, but another name which people may have heard of but may never have looked at is Hub24. So Chris, maybe you can tell us a little bit about the company first.
Yeah, so they're a fintech company, a very large one. We've actually done quite well with these guys for quite some time. We got in very early with Hub24. And at the moment, we feel like they're positioned very well. So we've just got them on a hold, a bit like Collins Foods. We've just got them on hold at the moment. They're very well positioned. And even with the near-term volatility in the fintech sector, the analysts feel like we're very soon going to be putting them on a buy. But again, Roger and I, we just thought this is another good opportunity, a massive company, just to put on your watch list. And then when the time is right, not trying to pick the bottom, to get in so you can reap the reward if you're happy to hold it.
That's it. And look, here's another good example, because they're a financial platform for advisors and financial planners. Even Fat Profits, we use the platform as well for managing money. And you can clearly see the funds under management that this company have grown and grown and grown. They're managing billions of dollars now, and they're a top 200 ASX company, quite a good size now, pay good dividend. And look, again, another example of early bird catching the worm. We bought them, around 2014 at $1.35. They didn't really do much for the first few years. If you can look at the chart here, nothing much happened. And some, impatient investors, in fact, even got out. But we had a 5 to 10 year time frame in mind, and we kept watching the space. And as they started to really grow, we started growing with them. And look, even if you put in $10,000 in a company like that for a period of time, and you put that away, today you're looking at close to $200,000. This is a huge return. And yes, we bought them over multiple times. We even sold half just last year, locked in some of the profits, because we don't mind selling something when the timing is reasonable, but we're keeping the other half on hold. And as Chris said earlier, we may even change that to a buy in the near future, but we're going to watch how the overall market performs. So this is another stock you can add to your watch list, top 200 ASX company today. But look, we have several names that we're watching at the moment, which are in the early bird stage, and we are going to be putting a lot of them as buys in the coming months. And that's the part which is why people join Fat Profits, because all you need is one of them, just one of them, for a 3 to 5 years or a 10-year time frame, and you've made some serious money. It pays for the service many, many times over, Chris, doesn't it?
Yeah, absolutely. As you can see there, an investment of $10,000. If you can get in early, if you can go back to that word, being patient, if you can dollar cost average, then the long term you'll really reap the reward.
Yeah, I'd love to have a few more hubs and Collins in my pool. Now, Chris, over to you, because there's a few investors today, no doubt, who are looking for dividends, and they want something around income, because it's really important for retirees and semi-retired investors looking for a yield from their cash. So what do we do for those people looking for dividends?
Yeah, and I've waited on a question from one of our attendees for you for this section because I knew it was coming up. So James, thanks for your patience, but I'll bring up your question a little later for Roger. Yeah, for our listeners, for our members, we have an income portfolio. Again, it's a guide, actually a perfect slide. It's a guide, so we help our members know what are the best income stocks to be looking at, putting in the portfolio. They're going to keep your risk at a minimum. They're going to give you fully franked stocks and also a good time to buy. So this is a list. We can't show all of our stocks in here because that's what members pay for. But the question was, Roger, because we've got this page in front of us. James just asked, Roger, I'm a retiree. I do only look for income, but I'm looking at stocks that have growth along the way. What can I do?
Was it James, was it?
James, yes.
Okay, thanks for the question, James. Well, look, if you're a retiree, one of the common things people tell us that they want is 2 or 3 things. One, they want capital preservation. You worked hard for your money all your life, and you don't want to risk it with speculative stocks now when you're retired. So that's the first thing we look at. Second, they want a consistent stream of income coming in every 6 months on the ASX. Now, with those 2 things combined in today's market, if you look at it, typically you'll get between 4 to 5% dividends across board on the ASX top 200 companies. Then you've got to cherry pick the ones which are paying more than 5, 6, 7, 8%. Some are paying even over 10%. But you have to be really careful, in our opinion, because just because a company is paying, let's say, a dividend of 8 to 10%, doesn't necessarily mean that that's the best company to add to your portfolio. Because the last thing you want is good dividends, but a falling share price. So what really you need as a retiree is the best of both, a fine balance between reasonable dividends and good growth. Now, this portfolio that we've constructed, it has got companies like, and I'll give you one name today, you can look at them, is Nine Entertainment. You can probably see that on the chart here on the left. Nine Entertainment, of course, is a household name, top 200 ASX company. They pay dividends in excess of 6% a year, fully franked. They've gone from $1.10 about 3 years ago to a high of $3. Today they're sitting just around $2, still very healthy. We've currently got a hold on them at the moment, not a buy recommendation today, but we may turn that into a buy on any market weakness in the coming months. So that's one stock you can check out. And just to finish off answering your question, this portfolio has 21 stocks. They're all in the top 200. And the real reason we designed this portfolio 11 years ago was to create a basket of stocks which pay good dividends and growth. Now, what are our returns so far? If you look on the bottom right, you will notice that the total return per annum has been 13.7% per year for the last 11 years on the ASX. Now, that's a combination of dividends and growth, and you can see that there. And I guess my question to you, James, or anyone listening, we've got over 400 people watching this today. I'm sure there are a few semi-retired or retired investors. I guess the first question I have for you guys is, what are your returns currently been like over the last 3 to 5 to 10 years, if you break it down per year? Are you looking at 5 to 10% a year? Are we talking 10 to 15% a year, or more or less? Or are we talking negative? Some people might not be doing very well. Maybe you're watching this webinar for a reason. You're looking for some information to help you. So I guess the question is, if you could notch up 13 to 14% a year, which we've done in this portfolio, and buy and hold companies. We're not trading in this portfolio. Just buy and hold. And of course, every now and again, we'll move something around. We sell something and buy something new, but that's very rare. And if you can notch up 13 to 15% a year, and you've got $1 million in your portfolio as an example, well, that's $130,000 to $150,000 a year, which is pretty comfortable for most people in retirement. How does that sound to you? Because that's the purpose of this portfolio, and that's what we've achieved. Now, Chris, I'll pass it back on to you, because we also tell members in this portfolio what sort of dividends they can expect to earn per year.
That's it. So the last chart will just show you overall. But here's a great example to James and anyone else looking for just the income side. So we've got the 21 stocks. We're only showing a handful there. But you've got your dividend per share, your net yield, your gross yield, and then stocks. If you can't find them, we'll tell you if they're going to be fully franked or not. So you can see the net yield is around 5.1, and then it's going to 5.2. The gross is what we like to look at as well. It's going to be increasing this year from 6.2 to 6.5. This is purely just the income side of the portfolio. So again, Roger, a lot of our members, and I've been here for a while, usually we do talk about income, where they're going to look for the growth side, yes, but also where they're going to get the income from each year.
Well, again, if you're a retiree or semi-retired, 6.2 or 6.5% yield per year out of top 200 ASX companies, handfully picked, is very comfortable. I know when I get to retirement, this is exactly what I'll be doing, is collecting my dividends, maintaining a growth level, keeping above 10% per year, and just buy and hold. And I don't have to look at the markets every day. I want to go out fishing and golfing, Chris, maybe with you one day, and we catch up.
Sounds great.
And that's what you have to do.
Yeah, absolutely. And the next slide shows not just about buying. Like a great example, we have Nine Entertainment in the income portfolio, but this is a list attendees of stocks that we've taken some profits and some losses. So I'll just stick to the top one. You probably recognize quite a lot of stocks. You might even be holding some of these stocks. Well, we can actually show that we do like to take profits and actually bank in some of the capital. So as we showed, Nine Entertainment, we only got into them in 2020. They went to $3, so we sold half. They're down to about $2 at the moment. So, and the last column, we're only saying in a minimum investment, if you did, of $10,000, 3 years later, it would be nearly $28,000 for Nine Entertainment. Some of the members put less, they put more. How much you put is entirely up to you, investors. We're just using the last column as a gauge. If you did roughly put in 10,000, these are the kind of returns. So as you can see, a lot of profits. We're not shy. If we need to take a loss, we'll take a loss. But you probably recognize some of these stocks. RAB was a great company, especially with the lockdown and forward driving and how they just completely changed in a very short time. So we look for opportunities. But again, Roger, if there is a profit to be made, even if it's selling half, then we will take the profits.
Absolutely. And look, we don't get all of them right. Let's just be straight about it. One of the things about Fat Profits, we're very open and transparent. If we get it wrong, we'll admit it. We won't make excuses. Look, we get 7 out of 10 right, typically. And look, no one gets 10 out of 10 right, but we're open about it. If you get it wrong, we're happy to take a loss and move on. But good risk management, good portfolio management can cover those losses very quickly. As you can see, 1 or 2 good big winners like Hub24, they can well and truly cover the small losses. So yes, losses will be part of investing. We understand that, but minimizing them and maximizing your profits is really what it's all about. Chris, we do have a lot of reviews as well. So people these days look at reviews from other members and product users. So tell us a bit more about this.
Yep, and I think I speak for Roger. Both of us are very proud of the product review page. So it's something where many of you would know. We can't touch that. It's just purely our members telling, I guess, the world how they enjoying our service. So we won't go through all of them. If you're really interested, you can go into product review and have a look at some of the reviews. I think David is your member, but there's he's a great guy. But there's another one. Doug just says, the best thing since sliced bread, which kind of made me giggle. But yeah, look, it's nice to hear because these are people, members. They've been with us for a while. They're using the service to their advantage, and they're actually performing. So it makes us feel really happy that we're actually doing the right thing.
Absolutely. All right. And before we provide some good news in a moment, there is some opportunity for those of you who are interested in maximizing your returns in the market. Chris, maybe you can highlight some of the key features of why people like Fat Profits.
Yeah, if you're thinking, why should I join Fat Profits or what's the benefits? In a nutshell, it's probably on this one screen. And get your phone if you want and take a screenshot. So as you can see, this is over 22 years with our wins and losses. If you bought and sold everything that we recommended, we averaged 16.7 over the last 2 decades. A lot of people don't have the time or inclination to do their own research, so they subscribe to us because we do it for them. Experience and reputable management. Again, you probably have recognized us many times on television. During those 2 decades, we're getting 7 out of 10 right, so we're very proud about that. But we will tell you, if there's a loss, there's a loss. We're not shy to say that. And giving just a bit of market direction, we do not upsell you. No cross marketing or upselling. What you pay for is what you get. We'll give you everything in regards to the service, and we're going to show you some of the offers at the moment. And as Roger said earlier, Angus and the team, we're managing real money in the markets, over 200 million. So that's a great gauge. If you're just umming and ahhing on the fence, hopefully that gives you a bit of understanding as to what you will get if you do come on board with us.
I'm sold, Chris. There's not much else to say. Well, what else is there? Well, the one thing which I like really is, and I've joined a couple of other companies in the past, is, the constant cross-marketing and upselling of different products. I'm not going to name one of our competitors, but one of them is it's got 16 different products, and they just bombard you with long-winded emails trying to sell you more and more of the products. That's just really a turn-off, and that's one thing we're proud of. We don't do any of that, and our members appreciate that. So let's give you some insights on the 3 products. We only have 3 products, not 16, and you can pick one of them, and that's it, job done. So what are the 3 products? Standard, Premium, and Platinum. Now, all of them, depending on which one you go with, they have come with a tax invoice, can be a tax deduction, but please speak to your accountant. We can give you an invoice under your super fund or your own personal name. It's really up to you. But what are the benefits? So in all the 3 key memberships, you get the 3 standard benefits, which are, you get the daily Fat Chat market commentary email every morning from our CEO, Angus. That covers all things about market each day, covers stocks, markets, charts, and anything which has moved. So you'll certainly be well informed reading that every day. Second benefit is you get weekly members only webinars. We do 2 webinars per week. Mondays, 12 p.m. Sydney time, we do a live webinar for stocks on the ASX. We cover 10 stocks every Monday, and we give you buy, sell, and hold recommendations. 10 stocks every week. So in a month, we cover 40 stocks with buy, hold, and sell recommendations. And we have a discussion on those 40 stocks in a month. That's a lot, and you'll certainly benefit from that. You can ask questions in these webinars. Second webinar we do is Thursdays. Every Thursday, our CEO, Angus, who's also a fund manager and the owner of the company, and the only fund manager that we know in Australia who comes and talks to his member base once a week, live in our studio, every Thursday at 12 p.m. What does he talk about? He talks about the macro events moving the markets. He explains what he's doing as a fund manager. Is he buying? Is he selling? Is he in cash? He explains, breaks it down, makes it easy for you as an investor to understand the brain of a fund manager, how he's doing in the stock market. Very well informed. So there's 2 webinars a week, both are live. They're also recorded. So if you can't watch them live, not a problem. You can replay the recording at any time. Third benefit is Friday Fat Wrap. That's a wrap up of any highlights that you may have missed during the week. So if you're a busy person during the week, not a problem. That email will cover every bit of highlight that you would have missed. So those are the 3 main benefits. Now, outside of that, Chris, there is a difference between standard, premium, and platinum. Could you explain the difference, please?
Yeah, nicely done. So standard, as you can see in orange, access to one of the following. So you can choose the ASX or global mining or global equities. Now, the difference between standard and premium is probably 3 things. You get to choose access to 2 of them. So you can go Australasian equities and global mining, or Australasian equities and global equities. You choose out of the 3 of them which 2 do you want. The benefit of the premium is you get an account manager. So for example, I won't be all of everyone's account manager, but someone like myself, a senior here, you will have someone dedicated to talk to, ask questions, get the answer from the analyst. We've got a whole customer service team, but you'll have a dedicated person, so you can just come from where you left off in your last conversation. So you've always got someone dedicated to talk to. Platinum, you get all 3 reports where you get to cover all different markets that we report on, plus that account manager as well.
Yeah, very good. Okay, so really Platinum is designed for people who are investing in Australian market and overseas markets. So really, if you're an international investor, Platinum is the way to go. If you're an Australian investor and you want mining as well as Australian equities, that Premium is really our most popular bundle because you can pick those 2. Don't be fooled by global mining. It is mining. It does have international companies, but most of these companies are Australian based. So if you're interested in mining and interested in Australian equities and also the dividend stocks, then those 2 will do the job for you. And if you only only interested in one of them, then you can choose standard. Now, before we show you the pricing, I do want to highlight one more thing. So just quickly show you our members area. So if you are wanting to get a bit of a sneak peek, once you remember, you get your password, you log in, and you go to the members homepage. There is a video here which basically is an introduction. But these are the 3 products. So you click on either or, and then you can just, each are weekly. So Australian equities is a weekly report. It gives you 4 to 5 stocks per week. Same with the global equities, gives you that, mining as well. And then within that, you can see all our latest recommendations, which, like I said earlier, you get lots of recommendations during the month. And we can see our Fat Profits portfolio. You can see all our past recommendations, winners and losers, everything we sold, any alerts that we want you to pay attention to, the income portfolio that we showed earlier, a sneak peek of, that dividend portfolio, if you remember, 13.7% returns per year, that is right there, and also all our webinars. So if you click on that, it will basically take you down to all our recorded webinars, and you can replay it, all of them, just by hitting the play button, and you can watch them. So all that said, what's the price? Let's have a look. So we've got some good news for you today. So here is the good news. So if you're interested in becoming a standard member, the normal price is $13.95 for 1 year. Very reasonable, and you can easily recover that by getting 1 good recommendation in a year. Premium is $19.95, and Platinum is $25.95. Now, the good news is we have some special prices for our audience today. So if you really want to go for a good value, we're offering 2 years for the price of 1. So really, it's very simple. $13.95 will get you 2 years. If you break it down, just about $6.95 per year. That is cheap. Honestly, for a service like this, it'll save you a lot of time, give you the ideas, and it'll pay for itself in 1 or 2 good recommendations. If you really want to get the best value, and if you're in it for the long haul, we suggest you go for 3 years. That will really bring your price down to $5.95 a year, and that total is $17.95. And you can take a screenshot of this if you want to just mull it over. Premium, on the other hand, is probably where I would go if I'm an ASX investor, because that covers both mining and the non-mining sectors. So $19.95 1 year, we're giving 2 years for the price of 1, bringing your average down to under $1,000 a year. And if you really want to get the best value, 3 years will bring it down to under $900 a year, so $895. Look, if I can spend under $900 a year, Chris, look, I'll be very happy, because that is an investment in my future earnings. Finally, the Platinum at $25.95, 2 years for the price of 1, pretty good deal. If you really want to bring it closer to $1,000 a year mark, I suggest you take the 3 years. That brings us pretty close to the $1,000 a year mark, and that gives you all our bells and whistles. Now, before we take some questions, we're going to pop up a registration question now. And if you're interested in Premium, for example, you can simply click that, and we'll set that one up for you, standard or Platinum. That's your call. I think a lot of people usually go for Premium or Platinum, depending on what you're looking at. However, there is one more option here, which is saying you can ask us to give you a free demonstration of our members website. We showed you a bit of a sneak peek just now. So Chris, what does that entail? What would we show them if they chose that option?
Yeah, so we didn't show you the portfolios. Roger was showing you the new recommendations. So if you just want to have a look at our members area and get an understanding on how to actually use a service, just click on free demo, and then one of us will call you. We'll share our screen and we can actually show you how the service works. I just got a question while you had this poll up, Roger, and maybe I can answer it if you like. Heidi, she just said, I only invest in Australia. Which one shall I pick? Well, looks like Roger, Heidi's going to be a member.
Sure.
So you would choose probably standard or premium, Heidi. Again, just to remember, you can only choose one report in the standard with no account manager. So if you did choose Australian equities, you're going to miss out on the mining. So my suggestion would be, if you want everything in the Southern Hemisphere, you'd probably click premium because it's going to give you the mining and the Australasian equities. But if you're still confused, just click on discuss a bit further, Heidi, and either Roger and I will call you, or anyone else. If you're still unsure, just click on that. Otherwise, if you know exactly which one you want to click, you can just choose the package there. But yeah, good question, Heidi.
Sure. Well, we've got another question from David. He's saying that I am an ex-member of yours and I'm sitting on a pile of cash. I am keen to do something with this cash, and I'm sure there's a lot of other investors in the same boat. He's saying that I'm more leaning towards joining the service in a few months when the market hits the bottom. What are your panel's thoughts? So David, look, we do think, look, timing is important. But we do think it will benefit you more if you really start to dollar cost average into this bear market. Now, we're not suggesting to buy them today, but certainly if you join our service today, you're only looking at the next few months before we think the market bottom will be had. And if that is the case, then you can start adding some of our stock recommendations to your watch list today, and you can start paying a bit more closer attention, do your homework, and get yourself ready. Also, you will benefit from the 2 webinars that we do each week, and they're not only entertaining, but certainly very informative, and will keep you in the right place to make that decision as to when to start buying and when to start dollar cost averaging, and which ones to avoid, because that's the other key thing we're suggesting to members, is to avoid certain sectors. And all that is only going to benefit you. There's no harm in joining 2 or 3 or 4 months before when you're about to take action. So we encourage you to give us a call or have a chat, and we will certainly look to help you as well. All right. So on that note, I think we've got quite a few registrations, Chris. So Heidi, David, or anybody else, look, if you made up your mind that you're happy to give us a go, look, we congratulate you, because one thing which my dad always taught me is mines and parachutes. They are very similar. They only work when they're open. So if you, it's a good one, isn't it, Chris?
I like it.
Yeah. So really, if you've got an open mind, you will get some new ideas inside it. You might try something different, and you know what? You might change the results, and that's what it's about. You keep doing the same thing, you're going to get the same results. So my final thing is, for those of you who are still tossing up, or maybe you've made up your mind that all I want is just the free information and I don't want to pay anything, that's up to you. However, we always say in these webinars, we can only provide so much free information because there's no such thing as free lunch. But if you really want to come on the other side, then join our service for a small fee, and we will certainly help you as much as we can. If you have any questions, you can email us, info@fatprofits.com.au, or any suggestions or feedback, we'll appreciate that. On that note, look, I'll pass it on to you, Chris, and I'll just say my goodbye. My name's Roger. Thanks for your time and your company today, and I'll pass it on to you, Chris.
Yeah, it's been great to join you too, Roger, and thanks to everyone who attended today. And look, we do hope that you did find something beneficial from the webinar today, and we really do hope out of the 460 that Roger and I and a few of us can talk to you and bring you on board, and we can show you a few things. But thanks for logging in today.
Okay, bye for now.